Sorry everyone, my laptop got switched off, so I'm starting the class again. So we when we assumed the R is equal to 10%, so we got the price of the board is 938.343, but the price of board should be 1,000 rupees. So I want bigger value, so I have to reduce the interest rate. So I just assume let R is equal to 7%. R is equal to 7%. So this would be 100 divided by 1.07. Then let R, that for 2 year that would be 1 plus 7% for the year 2, that would be 100 divided by 1.07 square. Then R, then the third year that would be 70 divided by 1 plus 7% for the year 3. So that would be 70 divided by 1.07 to the power 3. Then for the fourth year, that will be 70 divided by 1 plus 7% for the year 4. That is 70 divided by 1.07 to the power 4. Then for fifth year, 70 divided by 1 plus 7% for the year 5. That is 70 divided by 1.07 to the power 5. Then 1000 divided by 1 plus 7% to the power 5, here 5. So this is 70 divided 1000 divided by 1.07 to the power 5. So find the present value. So one by one, you can find the present value. You can do with calculator or you can do with Excel. Okay. So you got here, this is for the first year, you got 93.4579, 45 or 43, 4579. For second year, you got 87.3439, 3439. For third year, you got 57.1409, 1409. For fourth year, you got 53.53.4027, 4027. For fifth year, you got 59.909. And then 1,000 rupees, you got 712.986. So do the sum of this. Yeah, Prakriti, construction work is going next to my home. So few things I cannot avoid. We could not able to sleep properly because of that work. Very annoying. So do the sum of this. So if you do the sum of this, you will get 1054.24, 1054.24, 1054 plus 24. This is the sum you will get. So if you take 7%, you are getting the price as 1054.24. So if I take R is equal to 10%, I'm getting a price as 938.343. If I take R is equal to 7%, then I'm getting the price as 1054.24. So, but I want the price to be 1,000 rupees. Okay, so that is what my YTM is all about. So there's no direct formula to find YTM. So what you can do to find the YTM, you have to use trial and error method. So if I take R is equal to 10%, then I'm getting the price as 938.343. And if I take R is equal to 7%, then I'm getting the price as 1054.24. So So to get the answer, what will we do? So we use interpolation to find your YTM. So your required YTM percentage is equal to lower interest rate. Same formula which I told you in past. Lower interest rate plus higher interest rate minus lower interest rate. Then so lower interest rate plus higher interest rate minus lower interest rate into value at low interest rate, value at the lower interest rate minus desired value, the formula which I always use to find the YTM, minus desired value divided by value at lower interest rate minus the value at higher interest rate. So your lower interest rate, what is that value? That is 7%. You can see 7% plus higher minus lower, 10 minus 7, value at lower interest rate, that is 1054.24, minus desired value is how much? 1000, divided by value at lower interest rate 1054.24 minus value at higher interest rate, that is 938.4. So that is your answer. So you can find this answer. Solve this, that is your answer. So if you solve this, you will get the answer. So 1054, that 10 minus 938.343. So this divided by this into 3% plus 7. So 7 plus 1.40401. 8.40401. The answer is 8.40401. This is your answer. So this is your YTM. This is your answer. Very simple. So I hope by this time you would have learned a lot of. You can see that in exam you definitely will get a question on YTM calculation and how to do that. So by this time you can easily have understood that part. How will you solve that kind of question? The shortcut formula is also there. So the YTM approximate value, but that will not work here. That there's a formula, that approximate value formula, that formula which I discussed in one of the numerical. That formula was interest plus half interest plus 1 by n, interest plus 1 by n of face value minus price divide by 1 by 2 of face value plus price. So that formula will not work here because you can see the cash flows are not constant. You are getting different cash flows. For the first 2 years, the cash flow is 100 rupees and then your cash flow is 70 rupees. So that formula will not work here. So this question you can do only by step only. So the answer you can solve this. So the answer for this would be around 8.40401. Anyone, any doubt? So I believe you have understood this part, and you know that whenever we talk about trading in the market, so whenever we talk about trading of, you know that I believe you know that the trading of debt instrument, that these debt instruments trade in the market. So these debt instruments, so what an individual can do, individual can buy and sell debt instruments in the market. So it's not like you bought the debt instrument for the price and then you wait for the debt instrument for the maturity, and then on maturity you'll get the face value. So in reality, there's a in NSC there's a segment where the debt market are being trading. So you have NSC wholesale debt market segment, so where the debt instruments are trading, and whenever the debt instrument trade in the market, so the interest rate, whatever the changes happens on the interest rate, that affects the debt, that affect the pricing for the debt instrument. So you know that the price of a debt instrument is inversely proportional to the YTM of the debt instrument, or the interest rate in the market, as what happens in the economy, the inflation rate. So you know that inflation rate, inflation data, inflation rate, so which again depends upon the reverse repo rate, which the RBI keeps on changing. So reverse repo rate, the RBI keeps on changing because of the monetary policy review, because of which RBI keep changing the repo and reverse repo rate. Because of that, what happens? The interest rate segment altogether will get effect because of that reason, and because of that only the inflation data for our economy also get changes, and that again it affect the price of the debt instrument. So whenever the interest rate, whenever the Reserve Bank of India or whenever the banking institution, if they increase the interest rate in the market, automatically the price of the debt instrument which is already trading in the market, the price will fall down. While in case if Reserve Bank of India and other banking institutions, if they reduce the interest rate in the market, then automatically the demand of already trading debt instrument, which gives a coupon percent more than the current interest rate, automatically the demand will increase and their price will increase because of that reason. So whatever happening in the economy will affect the pricing of the debt instruments which are already trading in the market. So I hope you are getting the logic. Imagine right now, if you go and invest your money in FD, if you go and open an FD account, or you go and try to put your money in any instruments right now, nobody will give you interest more than 5%. Okay, so wherever you think of doing investment at the current scenario, hardly you will get 5% interest in FD, any other risk-free instrument. Imagine there's a debt instrument which has promised a coupon of maybe 7%. So automatically there will be demand for this debt instrument because everyone in the market is giving you 5% coupon, means 5% interest rate, and this debt instrument has promised the investor 7% coupon. So automatically everyone will try to buy this kind of debt instrument, and automatically if the demand will be there, automatically the price of this debt instrument will increase. So what happens? The pricing, when you see the price of a debt instrument, it actually uh, get ups and down because of the demand for the debt instrument in the market, and that demand ultimately is dependent on the interest rate data for the economy. So I hope you're getting the logic. So the price at which the debt instrument trades in the market, that price is called as clean price. So the price at which you see any debt instruments are trading in the market, if you log in into NSE segment, or you go to BSE website and you see different debt instruments are trading. So there would be a price at which they are trading. That price is called as clean price. And what happens whenever anyone buy or sell debt instrument, that trading happens at a price. That price is called a dirty price. So dirty price is nothing but it is clean price plus accrued interest. So the dirty price is nothing but that is clean price plus accrued interest. So you type in Google about clean price and dirty price, you will get lot of information about what is clean price and what is dirty price for the debt instrument. So you can type here in Google clean price and versus dirty price. You can read about them. So you can read about what is clean price, what is dirty price. So the clean price is the price of the coupon bond not included the accrued interest payment. So clean price is the price at which any debt instrument trades in the market. That is what we call as clean price. All that information is given. So then what is dirty price? So whenever you get time, you read about them. So I'll explain you that part. What is accrued interest? So what is accrued interest? Understand this part. So what is accrued interest? To make you understand accrued interest, suppose there's a 5-year bond. There's a 5-year bond. 10% is the coupon rate. 10% is the coupon rate, and the face value is 1,000 rupees, and the face value is the 1,000 rupees, and the interest is paid annually. And the interest is paid annually. Okay. Suppose I sold this bond. Suppose I sold this bond after year and 3 month. Okay. Suppose I sold this bond after 2 year, 3 month. Okay. So the current price of the bond. So the current price of the bond, suppose, is 900 rupees. Okay. So what would be the dirty price? So actual trading will happen at the dirty price. So you have to understand what is the dirty price. So you see, understand one thing, that this bond is paying coupon annually. Okay, so after every 1 year, this bond will give you coupon. Okay, so as an investor, you receive the coupon at the end of first year, and you receive coupon at the end of second year. Okay, and then you are supposed to receive the coupon at the end of third year. But what you did after 2 3 month, after 2 year, then you waited for 3 months, and then you are selling this bond. Okay, so if you're selling this bond, So means that you are not gonna get the coupon of the third year, fourth year, and fifth year. Are you getting me? So you are not get the coupon for the third year, fourth year, and fifth year because you are not waiting for the third year, fourth year, and fifth year. You are selling this bond after year, okay, because you are selling this bond after 2 year. So because you are selling this bond after 2 year, so you open for third year, fourth year, and fifth year. But the other person can say that the other person can say that he has invested for additional 3 months. The other person can say he or she has invested for the additional 3 months after 2 year. Okay, so he wanted compensation. You're getting me? So the other person will get the coupon only after 9 months. Logically, everyone should get the coupon after 1 year, but this person is selling this bond after 2 year and 3 months. So he should get some value for the additional 3 months for which he has invested. Are you getting me? So the dirty price in this case would be 900, which is the clean price, plus 3 by 12 of the coupon. What is the coupon? Suppose 10% of 1,000. So the coupon is 100 rupees. So he should get that value because he has stayed invested for the additional 3 months. So the 100 rupees coupon, what the company, what this investor, the other investor will get after the end of third year. So the other person should not get 100 rupees. He should get less than 100 rupees because the other person has done investment only for 9 months, and this person, he continued the invested investment after 2 years. He continued 3 months further, so he should get some value of that 3 month. Are you getting me? That is called as accrued interest. So the dirty price for this would be 900 plus 25. So the accrued interest for this would be 925 rupees. So 25 rupees extra the other person has to give to this person. Why? Because this person has continued the investment for additional 3 months after 2 year. If you would have sold after 2 year only, so if this person would have sold after 2 year only, if this person would have sold after 2 year only, then the clean price and dirty price would have been same. Then the clean price would have been equal to the dirty price. But because he has done investment for further 3 months, so he should get some value for the additional 3 months where he has done investment. So the extra 3 months what he has done investment, for that he should get in value. Are you getting me? Because the coupon is paid after 12 months. Okay, the third coupon is paid after 12 months. So the third coupon is paid after 12 months. The third coupon is paid after 12 months. Okay, so the other person will receive the coupon only after 9 months. The other person will receive the coupon only after 9 months. And this person who is selling this bond, he has invested for the additional 3 months after 2 years. So the additional 3 months, what he has done investment after 2 years, he should get in value for that. And that value he'll get, that value what he get, that is called as accrued interest. So that is so this is the logic what we follow. So where the actual trading happens at the dirty price, where dirty price is the clean price plus accrued interest. Remember this logic. Okay, everyone. So this much from the today class. Anyone have any doubt? Any question you want to ask? Okay, so then I'll take attendance if nobody have any doubt. आकाश, भरत, भावना, चैतन्य, दर्शन, दिव्या, गीतांजलि. Guys, answer your attendance. Bhavna is there. Harish, Karthik. Bhavna is there. Karthik is there. Harish is not there, I guess. So Karthik is there. Then Kavna, Kirti, Kiran, Mohan. Mohan is there. Mohan, are you there in class? Prajwal is there. Prakriti is there. Priyanka is there. Ranjita is there. Rakesh is there. Ravi Teja. Ravi Teja. Ravi Teja is there. Ravi Teja is there. Rohan, Sachin, Sanjay is not there. Shakib is there. Shakib. Shakib is not there, I guess. Shakib, are you there? Ravi Teja is there. Suraj is there. Vidya is there. Yogeshwari is there. Anyone? Rohan, Sachin, Sanjay, Shakib, Shalini, Virendra, Pawan, Nagaveni, Mohan, Kiran, Kirti, Kavna, Harish, anyone? Akash, Bharat, Darshan, Virendra is there. Okay. Anyone? I hope everyone is there. So I give you the attendance. Anyone? Akash, Bharat, Darshan, Harish, Kavna, Kirti, Kiran, Mohan, Nagaveni, Pawan, Rohan, Sachin, Sanjay, Shakib, Shalini. Done everyone? Anyone? Any question? So can we? So we'll end the class then. Thank you everyone. See you all tomorrow.